From the Wall Street Journal, a real estate juggernaut ran off the rails in 2023. Article covers non-traded REITs experiencing fundraising problems and shareholders cashing out. From 2019 to 2022, a new type of real estate fund became one of the hottest fundraising juggernauts on Wall Street by giving individual investors the chance to participate in soaring values of apartment buildings, warehouses, and other types of commercial property. Last year, those funds known as non-traded real estate investment trusts ran off the rails as concerns increased about the troubled commercial property market. Fundraising plummeted by the fund's sponsors, many of them in giant investment firms such as Blackstone and Starwood Capital Group. Meanwhile, redemptions soared as shareholders rushed to cash out. Sponsors were hit by so many redemption requests at the same time they had to implement fund rules limiting the rate with which people could get their money back during such runs. Like public REITs, non-traded REITs buy commercial property, allowing investors to share in their incomes and increase in values. They're also known for paying high dividends. The main difference is that shares in public REITs are traded on stock exchanges, while investments in non-traded REITs are made mostly by individuals through financial advisors. Um, I would say the main difference there is one trades and the other one doesn't trade. By trading, you go on with a public REIT and you offer to sell and you'll get the price the buyer is willing to pay at any time. And there's generally almost always a market there. The prices just may fall more than you think is warranted. It's dictated by the market versus non-traded REITs. The funds themselves are going to appraise and put a value on those shares. In some cases, they're not going to fall as much. But the big caveat there is if they get hit by too many redemption requests, you can't get your money out. They'll stop selling if they don't have enough cash on hand. And they may be forced to actually sell properties at prices they don't want to sell to raise cash to fund redemption requests. So that's the big difference here between the common publicly traded REITs and these new class of non-traded REITs. And some investors had not experienced that facet of not being able to get their money out. And the article will also go into talking about how some investors worry that those REITs are not fairly valuing the properties they hold. Going on, non-traded REITs raised $9.8 billion last through November, compared with $33.2 billion during all of 2022. Meanwhile, investors redeemed about $17.4 billion through November, far surpassing the $12 billion redeemed in all of 2022. Redemptions did slow toward the end of 2023, but outflows are expected to continue to exceed funds raised as 2024 begins. That's going to put pressure on these non-traded REITs. The strain in the non-traded REIT business also fueled a debate over whether the funds are accurately valuing the property they own. Sponsors say the valuations accurately reflect the market and the property they own, but others say redemption requests are so high and the fund's new fundraising is so low, partly because investors think non-traded REITs haven't reduced the value of their shares enough. Honestly, this is a difficult question to answer. The REITs are going to value themselves. So there's going to be some level of question whether they're accurately valuing their own assets, but the methods they're using. At the same time, there can be a spread with publicly traded REITs where if investors want to get out in the publicly traded ones, they're going to be able to sell only at the price a buyer offers, which could be less than what the property actually is worth. So there's really both sides of this argument, but it does go to a feature of these two different products. In public REITs, the market's going to price it what a given buyer and seller are willing to pay at a given moment of time. And on the non-traded REITs, they're going to be valuing the assets themselves. And there's going to be some level of distrust sometimes that they're not being accurately valued. Again, caveat emptor, buyer beware. You should understand the implications of both types of investment vehicles. Going on, the imbalance between inflows and redemptions has helped push the net asset value for all traded REITs down to $96 billion from the peak of $110 billion a year ago. It has also put pressure on the sponsors to sell assets to meet redemption requests. Public and private REITs have been hurt by the commercial property downturn, caused largely by high interest rates that raise borrowing costs for landlords. Where rates have started to fall, few observers expect them to drop far enough in 2024 to ease the strain in many property sectors. Non-traded REITs also have lost their appeal because their share prices haven't fallen as much as public REITs. Now, that's true. If you want to get a better bargain, you're probably going to look at a public REIT where the share prices have fallen more. Fund sponsors say their valuations are higher than many of the public REITs because they own better quality properties. That may or may not be true. I would point more to the market pricing mechanisms that are going on here. But the fund's share prices give existing shareholders an incentive to cash out if they are worried that continued woes in the commercial property industry will push values further down. Investors are also likely reluctant to invest new money into the funds for the same reason. They may feel like that, unlike shares in public REITs, fund shares aren't being sold at enough of a discount to justify taking a risk in commercial property. Analysts say, I would just point out you're probably getting a better bargain if you're going to use one of these two vehicles to use the public REIT option. Quote, investors are saying that they're not buying the fund's valuations because they're not giving them money and they're redeeming like gangbusters, unquote. Well, I guess that is the bottom line here.